there is hope that the wedge tightening cycle is over. U.S. Treasury yields fell significantly on October 10th local time. This is the highest decline since March. The fact that government bond yields have risen sharply and reached their peak over the past few weeks has brought relief to the market. If the 10-year U.S. Treasury yield continues to be high at the highest level since 2007 on October 10 local time, this could replace the Federal Reserve's interest rate hike. The 10-year U.S. Treasury yield recently rose to the 4.88% range, hitting the highest level since 2007. Over the weekend, news of the war between Israel and Palestine strengthened the preference for safe assets, causing the yield on U.S. Treasury bond to fall to the 4.64% range. However, even in this situation, U.S. Treasury yields are still high. The Federal Reserve began raising the benchmark interest rate in March 2022 as the price rises steepened. The target range of the federal funds rate, which was at the zero level, has now risen to 5.25 to 5.50%. The Federal Reserve froze the base interest rate after the regular meeting of the Federal Open Market Committee in September, but left open the possibility of further interest rate increases within the year, leaving open the possibility that high interest rates will continue for a long time. After the September meeting, bond yields rose in the bond market as they digested the prospect that high interest rates would continue for a long time. Recently, there has been a growing argument among Federal Reserve personnel that the Federal Reserve should stop raising interest rates as government bond yields are soaring. As long-term bond interest rates have recently risen, some members of the Federal Reserve have shown a cautious attitude toward further interest rate hikes, highlighting expectations that the Federal Reserve will turn to the pigeon wave. The argument is that because the U.S. economy has entered a soft landing orbit, there is no need for the Federal Reserve to raise interest rates anymore, and there will be no economic recession in the future. With these remarks, government bond yields fell. The benchmark interest rate, 10-year government bond interest rate, was traded at the 4.62% level, down more than 12 BP from the previous trading day. The increased demand for safe assets due to the conflict between Israel and Hamas also encouraged the rise in government bond prices. The conflict between Israel and Palestine became a factor in lowering bond interest rates on this day. The expansion of geopolitical risk is a factor in lowering interest rates on bonds, which are usually safe assets. International oil prices, which had soared the previous day, also turned downward due to the prospect of supply disruption due to the war between Israel and Hamas. On this day, the price of West Texas Intermediate crude oil for November delivery on the New York Mercantile Exchange and trading at $85.97 per barrel, down 41 cents from the previous day. New York stock market experts analyzed that the decline in government bonds yields on this day supported the market. Investors paid attention to the Middle East conflict and movements in bonds yields. Falling bond yields are a key driver of rising stock prices.